to the trading psychology and discipline webinar with Thomas. I'm Thomas. I will be the one hosting the webinar today. Feel free while the webinar to ask any questions that you may have. We will go through today some of the basics of trading and understanding how important it is to have a disciplined trading journey. And I'll be happy to share with you today from my experience as an account manager. For many years, I got the chance to discuss with many of the clients of AvaTrade and experience what are the main difficulties that clients are having. And definitely psychology is one of the most important things when you are trading. And we will be able to discuss it today. And before we start this risk disclosure, any capital markets and trading information disclosed in this webinar is provided for informative purposes only and should not be constructed or applied as investment advice, a recommendation or suggestion. CFDs are a complex trading instrument and come with a high risk of losing money rapidly due to 57% of retail investor accounts lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money, and you can visit the full risk disclosure on our website. So basically today what we will be discussing and some of the features we have on the WebTrader profit and loss calculations. We have a tool inside the WebTrader I will show you today that can calculate for you what is going to be your profit or loss when the value reach a certain price based on the lot size that you select. Trading psychology in general, what is the importance of trading psychology and how we're going to use it in our daily trading, risk management, how to decide what kind of risk exposure, risk appetite you are having. It's something that you decide what is the level of risk you want to take. And I will be sharing with you today how you can limit your risks and how you can know in advance how to calculate your level of risk. Platform essentials, opening, closing position, pending orders, stop loss and take profit margin calculator, trading history, AVAProtect extra feature that we have, account types and benefits, standard account we have VIP accounts, spread deductions we also offer to some of the clients depending on account types and benefit of working with an account manager. The key account metrics: balance, equity, free margin, used margin, margin level, and how to increase your margin while having positions open. So we will be discussing today. We'll also go through what is hedging, how to hedge a position, and what are the benefits of hedging, and education and improvement, always how to learn from each trade and obviously from your journey and how to improve upon your trading in the future. So basically this is the main screen that you will see when you log into the WebTrader. How you log in, you go to the website avatrade.com, and then once you go to the website you will be able to click login, and then you will be able to see this screen. So I've already logged in. You can see on the left top 3 blue lines. You have here my accounts, payments, tools. If you click accounts and then accounts, you'll be able to see all of your account numbers. if you wish to have a few accounts, some of the traders, they like to have few accounts for different reasons, maybe for diversification, one account to trade on currencies, one account to trade on commodities, one account to trade on indices. It is entirely up to you. One account maybe that you have money in, and then you transfer money from one account to the other account. So this is also something that you can always set a few different accounts. We have, when you click add an account, you can set up one demo, so you can use it for practice, to practice different strategies. And if you don't really know how to open trades, how to close positions, and the basics, you can also learn on the demo. And when you do open a real account, then you can select the currency that you want to trade. But by the way, this is a question that is being repeated quite often. What is the connection between the currency of the account to the instrument that you are trading with? So basically, when it comes to an instrument that you are trading, the majority of the instruments are being traded in dollar. So if your account is in dollar, the conversion will be minimal. There won't be conversion when you are trading on an asset that is traded in US dollar. But if, for instance, your account is in euro, so when you are trading on an instrument that is traded in dollar, there will be constant conversion between dollar and euro. So this is a question that is being repeated. Normally, clients like to ask this question, so I just share. Now, another question that is being repeated quite often is, what is the difference between MT4 and MT5? So the two platforms are quite similar, okay? But the MT5 platform have extended amount of stocks that we offer. Majority of the stocks are about 64 pages full of stocks that are available on MT4, on MT5. Okay, so if you want to trade more stocks, you can use MT5. Also, we offer nano lots on MT5 on some of the indices and some of the stocks. Nano lots is that you add another 0.001. I will share with you now how it looks like the nano lot. So these are the main differences between MT4 and MT5. Also, you have a trailing stop that you can use on MT5. And that's it. Now, if you want to submit, to set up another account, you can do that. And that's just the relevant page where you can see your account. Then if you click trade, you will be able to see the trading platform. On the left top, you can search for a symbol, and then you have a watch list, favorites, hot, most rising, most falling, most buying, most selling, divided by categories, forex indices, crypto, commodities, stock, ETF, bonds. All these are instruments that we offer, divided by different groups. So forex is equivalent to trading on currencies. You trade on one currency against the other currency. Indices, if you know what is indices, is an index that is basically combined amount of stocks. So the index will represent a certain amount of stocks combined. Crypto, some of the traders here may not have crypto, depends on the account type. For example, for Islamic account type, there's no crypto, and also it's something that if you wish, so you can see here you have crypto, and you have the commodities, and then you have the stocks, as I mentioned before. The thing with the stocks that you have here, when you click, you see a larger selection divided by Canada, France, Germany, Italy, UK, US. And if I click on the US, what will happen? It will give me the stocks that are more correlated with the US market, US stocks. As you can see here. And it means that the stocks are traded in US dollar. So if you are trading on stocks and instruments that are traded on dollar, you need to look also on your account currency, and then you know if there is a conversion, constant conversion between the dollar and your account currency. So this is something important to know. And now we can proceed with the presentation. Okay, so this is the WebTrader screen that I showed you. Here, this is the trading account overview panel that you can see this on the right top. This is very important for you to understand what each one of these means. Okay, so we have the balance. It represents your closed positions. Okay, and I will share with you now examples how the balance affecting you. Whenever you close a position, the balance will change. Whether if you close a profitable position, so the balance will go up, and if you close a negative position, then the balance will go down. But the balance does not represent your real account value, because the balance does not take into account your open position. And again, this is something very important that a lot of traders are getting confused between the balance and the equity. So I will clarify it for you that the equity represent the real value of your account, including your open position, and the balance will represent your closed positions. And I will share with you now a few examples. The free margin is basically the amount of money you have to place new orders. So if you want to open a new position, the free margin should always be higher than the margin required to open a position. So let's share a few examples about balance, free margin, and equity. I will share with you live. So you choose something to trade, whatever you want, okay? I'm choosing something random, let's say BTC, okay? Bitcoin. For the sake of the example, here you can see the minimum is 0.01 lot, and we offer on MT5, I explained to you that we have nano lot, so you can see 0.001 lot that you can trade. The margin impact is the amount of money that is required to place this position, okay? And how much money I have in my account? I have free margin of 3,626, so I can open this position. And okay, I will choose something a bit higher for the sake of the example. What will happen to your balance, free margin, and equity? So once we open this position, you see we're not using the full exposure of the account. So if we want to use the full exposure, the maximum we can open is 0.37. Okay, I click to execute the order, and you can see the order is being opened on the position. Okay, so what we have here, so you open the position, you see the used margin is the amount of margin that was used to open the trade. The equity is being taken into account also, that amount that you see here, the loss of 257. It's starting with the loss because this is a part of the commission, also called spread, that you are paying to place the order. So sometimes when you open an order, you see it starts with a minus, but later when the market goes on your favor, then the minus goes into plus, or if the market is going against you, the position go into minus even further. So you can see here free margin is negative because we have used all of our available margin. This is the biggest position size that we could have opened with the size of account that I have here. And now the balance, you see, it will change once I close this order. Okay, so if I close this order, if anyone can tell me on the comments, if I close this order, what do you think will be my balance? So once I close these positions, what will be my balance? The calculation is 3,626 minus 400 and something. Okay, so let's see. I close the position. And the balance have been adjusted accordingly. And also the equity have dropped accordingly as well. Okay, so this is the three major things that I wanted to share under the overview panel, so you will be a little bit more familiar with how it looks like, since this is a question that is being repeated a lot. Okay, use margin is how much margin was being used to open the position. Also, this is something that a lot of traders are not aware. They don't know what is used margin. So what happens when you close all of your open position? The used margin is a collateral that will be added to your free margin once you close the position. Okay? So if you want to know how much money you will have in your margin to place new orders, so you can check what is the margin impact, the required margin to open your position. So also this use margin is very substantially important to recognize. Then we have the margin level. The margin level is also very, very important because this will determine whether your account will get stop outs. What is stop out? Stop out is that your margin level reach below a certain percentage. Okay, in EU it's below 50%. Position will close automatically below 50% margin level, and outside of EU is below 10%. The position will be closed automatically, and the reason the position is closed, so obviously count will not be getting into a negative. So we close the trade at a certain percentage, and also is a regulatory requirement for EU. That's the 50% mark. And I will share with you now how it works with the margin level. You can keep the margin level as high or as low as you want, but you need to understand that if you keep it above a certain percentage, let's say above 100%, 200%, 500%, 1000%, the bigger percentage that you go with the margin level, it is less likely for the position to get stopped out, because it means you have enough room in the account, you have enough margin, or the position that you are opening is relatively small to the amount of money that you are having. So I will share with you now how it looks like with the margin level. So the way it works, if we go back again to Bitcoin, for example, if I open a trade with a minimum of 0.0001, which is nano lot, once I open the position, you can see my margin level is very high. It's 324,000%. Okay. It means that the position is representing a very small amount of my free margin. Okay. If I open another position, let's say now I go bigger, I go to 0.01 lot. My margin level now dropped to 3,200%. Okay, it means that I'm starting to use more of the margin from the account. Okay, and the point here is that if you use all of your used margin, the margin level will be equivalent to 100%. Okay, so 100% in that case is relatively low margin level percentage, 100%, because on 100% means you're using all of your free margin. You don't have any free margin left in the account. You're using everything. If you reach to 100%, how do I reach to 100%? I need to close. I need to open more positions. For instance, you see our free margin is 3,042. So I need to open a trade that is equivalent to, let's say, 0.32. It's a little bit too much. So I go with 0.1, 0.19 is okay. 3.1 thousand is a little bit more. Okay, so 0.31 is maximum I can open. Once I open this position, my margin level will drop to almost 100%. Let's have a look at it. You see, dropped even below 100%. Okay. Why? Because we have used all of our free margin and got even into a negative floating on this position. So we got a little bit even into negative. So the margin level now is 92%. What happens when I start closing positions here? If I close the smallest position, my margin will relatively increase on smaller scale. You see very tiny change. Still we're at 93%. Then I close another one. It jumped to 96%. And then when I close another one, margin level will disappear because we do not have any open positions. So the margin level only relevant when you are having open trades. Margin increases when you close the position. The margin that was used will go back to the account. Now we have hedging. Okay, what is hedging? This is also something that is being repeated a lot, and I see many traders like to use hedging. So basically, hedging is that you open a position on the same instrument, the same lot size, and different direction. Okay, so let's give you an example. Let's go to, let's say, Palladium. Let's go for, let's say, 0.1 or 0.8, 0.7, 5, 9, 8. Okay, 0.77 is something we can open, is the maximum exposure. So when I open the position, you see my margin level dropped immediately to 78%. Since this position is quite big, I cannot even hedge it. Because in order for me to hedge a position, I need to have above 100% in the margin level. So what do? I need a position. Let's say I do a partial. You can also do a partial closure of the position. So let's say I close 0.1. Still, my margin level is low, 85%. So I need to close more since I want to hedge. I want to hedge my trade. So let's say 0.2. Okay, I'm above 100%. So we have palladium. Palladium. You see, the margin impact is you don't need margin to open this position, okay, because of the fact that we have 0.47 open. So you see on your open trade, you have 47 buy. When we want to hedge the position, it's called fully hedged. We open 0.47 sell. You see, you don't need any margin requirement. And what happened now? We are fully hedged on palladium. One position is buy, one position is sell. The positions are quite big in exposure, so I've already paid some spreads to open the positions. But when you are trading on instruments like this that are quite volatile, we will keep them, and you see that the prices will be changed throughout the webinar. I wish I could keep them, but we need some margin to experience some other positions. So I will give you the demonstration on a smaller amount of hedge. Okay, so for example, we go for palladium with 0.1 lot. Buy. This is the first position. I'm not fully hedged now. And then I go for palladium. .1 lot. Sell. And now you can see you are fully hedged. Okay, we have one position, 10 contracts on palladium sell, and 10 contracts buy, and I'm fully hedged here, which basically means that I did not need to have margin for the hedge position. The margin is being deducted from my account for the first position that I have opened. For the second position, I did not need an extra amount of margin required for the trade. And now I can keep these two positions for the sake of the example. So by the end of the webinar, you will be able to see what is happening to these two trades. Now here, I give an example. And now we are discussing some of the basics. Buy and sell, difference between them is the spread. Lot size, this is very important. It determines the profit and loss you're going to have per each market movement with you or against you. So if you trade on a bigger lot size, your profit or loss will be bigger. If you trade on a smaller lot size, your profit or loss will be smaller. A margin impact represents the amount of margin required to place the order. The leverage also represent how much margin is required to place an order. So if your leverage, your current leverage is higher, you need less margin to place an order. And if your leverage is lower, it means you need more money, more margin to open a position. The leverage, a lot of people are have a misconception about the leverage, and they don't really understand that the leverage is determined by the regulatory environment that you're trading with. So if your account leverage is more limiting, you can trade on a smaller position size, or you can trade on a bigger position size if you had more money. And on a bigger account, on a bigger leverage, if you have the ability to open bigger positions, it means that you can take more risks in the account, but not necessarily you will want to make these risks. So it depends on you and your risk appetite, and whether you like to trade on a bigger positions, and whether you want to take bigger risk, or whether you are more conservative with your approach and you want to take smaller level of risks. Now I will go through a new product that we launched a few months ago called AVAProtect. This is a product that enables you to have a certain protection on your money. So how it works, you pay a certain amount of money upfront. It is deducted from your account. And then if you lose money within a certain duration that you select for the AvaProtect, the money is being reimbursed automatically, either when the position will be expired with the duration, or either if you close the trade in a loss within that duration. Okay, so if the position is in profit, you will not really get any reimbursement for the protection. So this is relevant for the losses. So here you can see here a few examples. Gold with one lot on an hourly, it costs $1,200. That I will show you here. This product is not available on all of the instruments. It's available on gold, silver, and currencies. You can see here below it says AvaProtect. The minimum lot is 0.01. For 0.01, you see it costs 11.26. This price may change depending on the market conditions, okay? And then 16, 17, it goes up to 2 days. Now, if I change the lot to 0.1, the price will be 332, will be 10 times higher. If I change it to one lot, the price will now be 3,324. I can't even open this position because I don't have a margin to place it. If I change it to 10 lots, I need 33,000. If I change it to 100 lot, I need 332,000. So the main point here is that as you go up in your exposure, as you go up in your lot size, you have the potential to make more profit, okay? But also it's more risky, and therefore it is more costly to get the protection from AvaTrade for this. So you can test it out on a smaller positions if you would like to see if you like it. Again, the way it works is that you need to open the position with the AvaProtect, and if you have a loss within the duration that you select, the loss is reimbursed when you close the position within the duration, or if you wait for the duration to expire, then it is being reimbursed automatically, but the position will keep going. So you can close the position after the duration expires, and then you can open another position if you want to use that protection again. So I hope it makes sense. I didn't get any questions about it. I hope it's clear. AvaProtect. This is a product that I can tell you many clients like to use. Some clients they find it very beneficial because of the fact that some of the clients like to trade on a bigger risk exposure, and when they have a bigger risk exposure, they want to use this product so they know how to basically predetermine their level of risk, so you know how much money you are potentially putting to risk upfront. Essentially here, if I trade with 0.1, see the $332 is the amount of money that I need to pay upfront to open the position. Okay, so then we have a few different examples. What is required to place an order with AVAProtect? You need to have a free margin for the position, and also the free margin needs to be higher than the margin impact plus the protection cost. When will the charges appear on the account? You are charged for the protection immediately when the position is open. How will my losses will be reimbursed? Losses will be reimbursed under two conditions: if you close during the protection period, if the protection period expires with a negative floating, the loss is reimbursed automatically by the end of the duration. Only losses that occur inside the protection are covered. How do you make profit with AvaProtect? You must earn more than the cost of the protection. So the position profit needs to be higher than what you paid for. What happens if my position continues after the protection expires? Any losses after the protection expires are not being reimbursed. Only the negative floating inside the protection duration will be covered. If there is no negative floating, so there will be no reimbursement. Now we give a few examples. Let's say we open a position on a 0.01 lot on gold. The protection cost was $39.33. A negative floating at the expiration of the protection was $100. You got reimbursed automatically from the system with $100. You effectively managed to save $60 because you should have lost that 100, and the 39.33 you already paid. Another example, if with a bigger position, one lot on gold, protection cost was $3,933. If the negative floating was $10,000, you get $10,000 reimbursed, and basically it saved you about $6,000 because you should have lost 10 and you paid $3,933 for the protection. So that's the reimbursement that you got within the duration. Example for a profitable scenario, small position, protection cost was $39.33. If you end with a profit of $10 by the end of the duration, you will have no reimbursement because there is no negative floating, and it means that you have lost around 29.33. That's what you lost because you paid 39.33, you made 10, so you lost 29.33. Another profitable scenario is if you trade one lot, protection cost was $3,933. If you end up with a profit of $2,000, again you will have no reimbursement, and it means that you have lost about $1,933 for the protection cost. So in order to be profitable, you need to close the position with more profit than the protection cost. So this was the AvaProtect. This is a product that you can use if you would like to test it out on a smaller position size or any position that you would like to test it on. And also we have account managers. If you want to contact an account manager and ask maybe your account manager how it works, you can reach out to him or to her, and you can discuss it further. Always you can ask for a callback. Normally we do offer account managers above a certain threshold for accounts above $1,000, and that's something to take into consideration. We also have VIP account types with more benefits, and you get more luxurious account manager, and also you can get more benefits such as spread reduction or interest accounts that we offer. And you can always reach your account manager, ask for VIP promotion, spread reduction, and stuff like that. And now we can continue with the calculation of profit or loss. But I see here we have a pending order. This is also something that is have to do with the psychology of trading, because this is a good strategy that you can implement on your trading, where you set parameters for the position to be open before placing the order, and the system will automatically open the position for you. Okay, and it can also close the position for you based on the value that you set for the take profit and stop loss. Okay, so for an example, I can share. When you trade on call, let's say here, I need to cancel AVAProtect. I click execute when price hits. I choose the price when I want the position to be open. Let's say I want the position to be open at 4,650, or I want it to be open at, let's say, 4,200. It doesn't matter, whatever you choose. If you think the price of gold is going to drop, or if you think the price of gold is going to increase, then you can open a certain position. And also you can choose your take profit and stop loss. You see you have two columns here. Here you have the column with the price, and here you have the column with the possible profit. Here you have the column with the price. Here you have the column with the possible profit. So for instance, if you choose possible profit $100 and you choose possible loss $50, the system will tell you what price the value need to reach to execute your take profit and your stop loss, and then you can just execute, and the pending order will be executed. This is an order that will only be open when the price reach 4,200. You can see the distance right now is $404 per ounce. We also set a stop loss and a take profit. A stop loss is an order that will be closed automatically when the price reaches a certain point. The system will try to close it, and on your take profit, when the price reach the take profit, it will also close automatically. So now this position can close it, keep it, can also adjust it as you wish. So the take profit order I've already explained. One important factor about the take profit is that the take profit order is a position that you are asking the system to close the trade automatically when the price reach a certain price that you have selected. You can see here on the new order page, this is the new order page. You can see here the difference in the price. So for 0.01, when the price of gold reach 4,700, my profit will only be $95, $96. But if I change that to 0.1, my profit will be $960. And if I change it to one lot, my profit will be $9,600, $700. And if I change it to 10 lots, my profit will then be 97,000. And if I change it to 100 lots, then my profit will be almost $1 million. Okay, so you can see here that when you increase the position size, you can also dramatically increase your profits or losses, of course. The same thing applies to losses. So if I check for the price of 4,600, or let's say 4,500, I'm going to lose $1 million with 100 lots. And then I change it to 10 lots, I'm losing about 100,000. And then I change it to one lot, I'm losing about 10,000. And then I change it to 0.1 lot, 1,000 loss. And then I change it to 0.01, which is the bare minimum. It's $100. So such a big difference and such a small amount of money that you will be losing. Obviously, it's relatively $100. Some think it's small, some think it's big. You are the trader. You are in charge of the account. You are the one who decide your level of risk and your level of profits. And this is something that is very important for traders to understand, that the tool that I'm sharing with you, take profit stop loss, you can use this tool to calculate in advance what will happen to the value of the asset. And you can set yourself with a trading journal, and you can set yourself with an Excel sheet or a Word sheet or just a notebook, and you can write the position that you want to open, and you can write when you're planning to close your position and what profit or losses levels you are expecting to have on this position, and use this tool to know how much profit or loss you're going to have on your positions. So this is the take profit and stop loss tool. You can change the numbers of the lot size. You can change the number of the possible profit. You can set possible profit for $10, for $100, for $1,000. You can change it all the time. So this is important for you to understand. Here I gave a few examples that you can see the different values. And this is in regards to the take profit and stop loss as a tool for calculations. Now let's go back to the two trades we opened initially at the starting of the webinar. You see the prices have changed. These are the two hedge positions. One is with a $40 loss, one with a $140 loss. And I could also keep them just for the sake of the demonstration. So if you will follow up with us on our next webinar, we can look what is happening to these two hedging positions. So if you are participating in this webinar on the next webinar that will take place next week, you can ask me what is happening with the two hedge positions, and I will share with you so you can get more familiar with what is a hedge and how it's going to basically look like when you are being fully hedged. And also you can always practice on a demo different strategies to get more familiar. So the main point of this webinar is, first of all, I want you guys to understand and get more familiar with some of the basics calculation. Trading is something that is very emotional, and if you have been through our previous webinars, we are also talking really on psychological factors and psychological factors that are causing us to open positions, close positions, and react to losses that we are having or react to profits that we are having. But it's very, very difficult to be disciplined, to remain disciplined, and to have a certain strategy that is consistent. And when I mean consistent, I don't mean that your strategy it needs to be profitable. I mean that that you will need to follow that strategy that you are setting. So you set a certain ground rule for when you are opening a trade and when you are closing a trade, and based on what variable and based on what market condition you're deciding to open the position. And you are also deciding in advance when you are planning to close it based on what profit or based on what loss. And then you have a certain strategy set, and you only need to copy and you only need to follow that strategy that you have originally set. And this is something that is very, very difficult. Some of the traders, it's very difficult for them to copy and to follow their own strategy. And the way to do it is you can set a journal, a notebook, and you can write on the notebook how many positions you are planning to open today, or I don't know, on a weekly basis. It's up to you. And you need to follow that plan. And also you need to know why you're opening the position. Is it based on a certain technical strategy that you have? Is it based on a certain fundamental strategy that you have? This is also very, very important. So you know what is the reason that you open the trade. Because if you know what is the reason, you can always improve, you can always change it, and you can always perfect it and gain more knowledge about your trading strategy. And in the future, when you are opening more positions, you want to get better and better and better and use the time to your advantage and gain more experience, and obviously go through more webinars and also gather some books. Some of the clients we are having, they like to focus on a certain niche area, and they are focusing on something like commodities, like indices, like currencies, and they only focus on one niche, or they focus on a few different instruments, and they are learning only about these instruments, and they are getting more familiar with these instruments. So if you are trading on gold, or if you're trading on Nasdaq, or whatever you choose to trade, you need to learn it well, and you need to know what is causing to the value of the market to go up and to go down, and learn how to make different speculations about the market, and most importantly also uh, set a strategy and be disciplined to copy your own strategy and to follow your own strategy, and that way you can improve from a trade to another trade to another trade and to another trade, and you keep improving from each position. And that's the purpose here. You want to improve. So you want to improve in two main areas. So you have the area of the analysis itself. Analysis means that you are predicting what will happen to the market, what will happen to the value, if the value is going to go up or if the value is going to go down. So this is the analysis. Also, analysis can be divided by the technical side based on the graphs, based on what happened in the history of the market. Okay, or you can base it based on the future events, different big economical events, or any event that is influencing the market. So this is the analysis part, and you have the psychological part. And the psychological part is that you are working with a certain plan, you're working with a certain um, journal, or with a certain discipline, and you are copying a certain strategy that you have and following your strategy. So this strategy needs to be clear: how many positions you open day, how many positions you open a week, what time of the day you're planning to open the trade, what kind of risk measurements you're going to have on your positions, whether you want to have a risk exposure of 5% of the account or 10% of the account, or whether you want to measure your risk in dollar. I want to have a risk of $100 a day, or 100 or 5,000. It's up to you, entirely up to you. You are basically the one who is in charge of the account. You are the one who's managing your account, and you need to get more familiar and keep improving. So I wish you a successful trading journey. I'm here. If you have any questions, you can write to me, or if you want to talk with one of our account managers, always you can reach out to customer service, ask for an account manager, or you can just write to your own account manager. If you check your emails, you can see if someone have been assigned to you. And I hope that you will learn from this webinar and you can implement it on your own trading. And if you wish to register again for our upcoming webinar that will take place next Thursday, you can register. All the best, everyone, and thank you for joining our webinar today of trading psychology and discipline. See you next week. Bye bye.